Hello and welcome. In today's session, we bring you a concise and powerful breakdown of the Reserve Bank of India, All India Financial Institutions, Undertaking of Financial Services, Directions 2025. These directions, issued on November 28, 2025, set out an updated regulatory framework governing how India's All India Financial Institutions, Exim Bank, NABARD, SIDBI, NHB, and NABFID carry out financial services operations, investment activities, subsidiary oversight, and dealings in domestic, foreign, and IFSC jurisdictions. These directions have been issued under Section 45L of the RBI Act 1934, empowering RBI to regulate financial institutions in the interest of public and financial system stability. The directions are effective immediately, except for paragraphs 11 to 17, which relate to alternative investment fund regulations and will come into effect from January 1st, 2026 or earlier if an institution chooses. These directions apply only to All India Financial Institutions, AIFIs, namely Export-Import Bank of India, Exim Bank, NABARD, SIDBI, National Housing Bank, NABFID. The document provides several technical definitions. Let's highlight the most important ones. Debtor company, any company to which the IFE has had loan or investment exposure in the last 12 months. Equity instruments includes equity shares, CCPS, and CCDS. Financial services company, very broadly defined, covering banking-related business, NBFC activities, credit information companies, payment systems, exchanges, depositories, merchant banking, portfolio management, credit rating, collective investment schemes, pension funds, forex authorized persons, and more. Subsidiary, as per standard accounting definitions. AIFIs must maintain board-approved investment policies and observe strict limits on investments in a single financial services entity, investments in non-affiliates, total investments in all financial services entities, investments in factoring subsidiaries, investments in deposit-taking NBFCs, investments in alternative investment funds AIFS. These limits are computed as a percentage of paid-up capital and reserves. AIFIs must seek RBI approval before investing in subsidiaries or financial services firms, except when all of the following are true. Investee is engaged in financial services. AIFI meets minimum capital norms and had profit in previous year. Shareholding remains below 10%. Combined direct and indirect holding remains below 20%. Investments in held for trading category are exempt. AIFI investment cannot exceed 10% of the non-financial company's paid-up capital. AIFIs cannot invest more than 10% of corpus of any AIF scheme, and total regulated entities together cannot exceed 20%. If an AIFE contributes over 5% to an AIF scheme that invests in the AIFI's debtor company other than equity, the AIFI must create 100% provisioning for its proportionate exposure. If investment is through subordinated units, the entire investment must be deducted from capital funds. IF commitments made before July 29, 2025 and certain notified AIFs like Swami Investment Fund I are exempt from many restrictions. For any activity requiring RBI approval, AIFIs must submit applications through the PRAV-H portal, RBI's online regulatory interface. AIFIs must maintain an arm's length relationship with subsidiaries. Key conditions include regular board-level review of subsidiary performance, periodic audits and inspections. Subsidiaries cannot start new businesses or set up companies without RBI approval. No controlling investments by subsidiaries without approval. No online access by subsidiaries to AIFI customer accounts. No unsecured advances to subsidiaries without RBI approval. All transactions must be non-preferential and market-based. AIFIs' foreign branches or subsidiaries, including those in IFSCs such as Gift City, may deal in complex financial derivatives not permitted domestically. However, they must ensure prior board approval, adequate expertise, demonstrable pricing capability, proper reporting to RBI, compliance with home and host regulations. They cannot offer products linked to the Indian rupee unless specifically allowed, nor accept structured deposits from Indian residents. All foreign and IFC operations must adhere to stringent capital adequacy, valuation, exposure norms, and must follow whichever regulation, home or host, is stricter. These directions repeal previous related guidelines but preserve all past actions, approvals, and liabilities. RBI retains authority to issue clarifications, and its interpretation will be final and binding. Thank you for watching this comprehensive breakdown of the RBI Directions for All India Financial Institutions 2025. Munses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup operational support and handling compliances risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company foreign university, BATF, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance.